amount of pricer I have for you does not take care of dividends, but that can be easily changed. We're not gonna dwell on it. Then we're gonna talk about another possibility that's used a lot in practice as well. And this is Monte Carlo based valuation. So we're gonna simulate, well, you know the idea anyway, from binomial, right? What did we do? We had to make a projection of the underlying asset price, right? And then, based on that, we could say whether we would exercise the option or not. So we're going to do the same thing here. The big difference is that this is a more comprehensive kind of valuation because the assumed stochastic process for the underlying asset price could be anything we choose. That's the beauty of this, right? Now, in the particular pricer I've posted on Husky City, we're making the typical Black-Scholes assumptions. So it's going to be geometric Brownian motion. But I'll have to walk you through the algorithm because you have to know basically how to do, what the idea is behind it, right? So we're going to talk about that. And the last model we're going to be talking about, it's also like actually it's called BS, but it's Bjorkson and Stansland. So the beauty of this, right, binomial pricing, we have to travel through a tree. It's some sort of simulation, right? Simulation-based valuation, clearly it's a simulation. We have to go through potential stock price paths, and then ask ourselves, okay, so what's the value of the option at that point in time? Here, what they did was they basically tried to get something similar to Black-Scholes by, simplifying the problem of trying to figure out when to exercise, right? So instead of assuming that you can exercise every instant, we talked about this the other day, right? How many how many instants are there during the life of an option? There's an infinity, right? Not very helpful. So what they did was just approximate and say, well, let's say there's 2 optimal exercise time. So based on that, what would be the value? So it's a formula as opposed to a simulation like number 2, Monte Carlo simulation or binomial simulation, right? It's a formula with plug-in numbers. That's the good news. The bad news is it's a horrendous looking formula, and you'll see it in a minute, right? But it's very fast to compute because it's a formula. It's not something that you have to run. And then we're going to compare it. And then we're going to talk about the hedging part of it. Why do we talk about valuation first? Well, because, if you do this professionally, you have to think about cost, correct? You can't just say, oh yeah, this is a great insurance, right? There's 0 variability, and let's go for it. Well, maybe there's 0 variability, but if it's very costly, you have to report to your client or your boss. It's going to be a very important reporting session, right? It can be very expensive. So you have to know, for example, if you have to buy a particular option, you have to know, is it overpriced? By how much, right? Sometimes it is still acceptable, because even if it's overpriced, the other options are even more overpriced. You guys see that? So you have no choice, right? And that's really what you're looking for. You're looking for a way out when you ask, okay, this price here, is that fair? Is that too much? Too little? Well, we're not going to clear that too little. But bottom line is you have to, and that's something we're going to do once in this part, but you have to do it all the time, every time you want to add some derivative position, right? So we're gonna do a quick recap on the Greeks. I have added a little bit more, so it's more than a recap. And then we're gonna go into the hedging. So the hedging, I've already mentioned it briefly, and you know, but of course when we go into the details, it's very long. That's why you have so many slides on there. But the general idea is that you wanna hedge basically the change in the value of the portfolio. Right? You wanna somehow minimize it, right? Not to a total zero, because that's not possible, but minimize it so that you don't lose. That's really what you're concerned with, right? So that's known as delta hedging. And so if you do delta hedging, you're gonna have to choose one kind of a derivative, right? And then if you wanna choose additional hedging, so you want to hedge not just delta, but let's say gamma. And some of you may not remember any of this, we'll recap that, like I said. But you're gonna hedge gamma. Then the idea is you have to use an additional kind of derivative. So that's two kinds of derivatives. And then if you wanna, I don't know, you wanna hedge vega, right? You have to add a third type of derivative, etc., etc. And so that's basically something we're gonna go through with one specific example. And then I'll tell you how to extend it when you, we're gonna do it on a simple position. It's an IBM position, and we're trying to protect it. And then what do you do if it's a portfolio you wanna hedge as opposed to just a simple stock or a single stock? Then you have a choice, right? So you can hedge individual stock positions in the portfolio, right? And or, because you can combine what I'm about to say, and or you could actually think of your stocks as groups within different sectors. So instead of you hedging the individual stock position, you could hedge the grouped position of each sector, right? Maybe you have in the financial sector you have 3 stocks, so that's what you're gonna hedge. Then you have another, I don't know, another sector, consumer discretionary spending or something, maybe three additional stocks. You group it and you think of it as a group to be risk, to be hedged, right? So that's what you're doing then, is instead of focusing on idiosyncratic risk, which is what you do when you hedge individual positions, you also now hedging sector risk, right? And last but not least, of course, you can decide to hedge, to look at the whole portfolio as a single stock, right? And if you do that, then you essentially hedging market risk, right? Then we'll talk about how to do that as well, right? But that's basically, as you can tell, there's a lot to talk about, and so let me get started, right? So first thing is in terms of valuation. You've seen this binomial model. You still have it with you, and it's still on Husky City, of course, right? The process. So here's a screenshot of an example, right? And this is an American option. So just to make sure that you understand, we can use it for American options. The only thing that you need to note here is, in this case, this particular pricer has not, we could change it, I don't know, I'm not gonna have time to do that, but we could change it to accommodate dividends. But for, there's plenty of stocks that don't pay dividend while a particular option is alive, so you can use it for that, right? So that's the general idea. So we're gonna use this particular example of an American option. So we usually estimate the value of both in call and a put with the same characteristics, right? So I'm gonna do that throughout the session as far as valuation is concerned, so we can compare the models, right? So once again, by the way, so, you know, I keep reminding you, I think it's worth doing it, right? The stock price is $50, but the call option that allows you to buy one share, it's only $8, right? That's the leverage effect, right? The call option will allow you to sell it, is same thing, right? Almost just about $8 as well. So so again, options are very, very cheap, right? So I guess I did not mention it here. So let me mention. So what is the difference between using this for European options and American options? So what you guys remember is that at every node, right? At every node in the tree, basically the value of the option, let's say the call option, is just the present value of the expected cash flow, right? So the two possible values when it comes to the children of this particular node is the up movement and down movement for that. We've computed that, we multiplied by the probability, right? We know this, and it's discounted. Let's see if anyone remembers. What do we discount this with? What discount with? What rate of return?
It's your risk-free rate.
Risk-free rate. Why? Because we're talking about derivatives, so we're pricing it, while taking the underlying asset price as given, so all the risk is already there. So this is what's known as risk neutral valuation, right? So discounting of the risk-free rate. So again, here I'm assuming this risk-free rate is per period, but if it's not, if it's annualized, then you guys know how to transform it into per period. Anyway, that's the idea. Well, this is what we use for a European option, right? And then, and then we move up the tree. Well, when it's an American option, you compare this versus what money you would make if you exercise it at this particular node, right? So you would make, let's say, whatever the stock price is at that time, at that point, right, in the binomial tree, minus the strike points. That's it. And so the final value for C is whichever is highest between these two values. So this value, if you exercise it, is known as the intrinsic value, right? And this value, if you don't exercise it, is known as the continuation value. You compare those two, and of course, at any particular node, you only need, and you can only have one value, right? So of course, you choose the highest of the two. And by the way, at that particular node, if it so happens that the intrinsic value is the greater of the two, then at that point, it's best to exercise the option, right? So it's a very rich, the binomial model is a very rich model because it doesn't just give you values, it actually tells you when to exercise, right? But of course, you have to apply that particular, right, that particular algorithm, right? So again, the whole idea is that, if you, let's say prices start here, then we have this binomial tree here, and then another binomial tree here, and we could go on like this forever, right? But I'm just saying that at a given point in time, at a particular node, the continuation value is the present value of these expected cash flows. That's the continuation value. And you also look at whether it makes sense to exercise, and if you exercise, how much is the intrinsic value. And so the value for that particular loan is the highest of the continuation value and the intrinsic value. Questions about the idea, right? And what's so different between that and what we did with European options? We did not have anything like intrinsic value in middle nodes because we could not exercise it, right? We could only exercise it at terminal nodes, right? But not anywhere else. Right? So that's the difference. Questions? Okay. So here's another version of that. So this one is more sophisticated because instead of saying, oh, at every point in time, let's say you do this daily, right? You only have two possibilities. Instead of saying that, now you recognize, well, there's an infinity of possibilities. So that's the big difference there. This is more sophisticated. Of course, it's harder to put into place, but we will of course do it, right? So the whole idea is we're gonna, instead of saying, oh, the stock price will follow a binomial path, we're gonna assume that it's gonna follow a geometric Brownian motion. I show you exactly what that means. Just by a show of hands, who has heard of geometric Brownian motion? Okay, so some people. It's a very popular stochastic process. So again, stochastic process is just a probability distribution evolving over time. That's it. That's what it is, right? So it's a popular stochastic process because Black-Scholes used it, right? But there are many others. And you can actually change this assumption. But anyway, that's what we're going to be using. And once we've simulated the asset price, then we're going to do exactly the same thing we did for in the binomial model, except that we're not going to visit trees. We're going to visit distinct paths, right? That's the idea. So once we visit distinct paths, and again, because it's an American option, we have to go from the end and go back up into the present, right? Go into, start in the future and go back into the present to come up with the value of the option at every step. So for us, actually, we're gonna simplify it. We're gonna use daily steps, right? And so once you have all of the values on day one, you compute the present value of those day one values, and you just average those present values. So let me walk you through this. So this is what a geometric Brownian motion looks like if you use it in a numerical context, meaning in a context where you want to use simulation, right? So it says the stock price at a particular point in time, right here. So this is day j plus 1. Right, is whatever the stock price was the previous day, right? And then you guys recognize this times exponential of something. So basically, you compute some sort of a future value, right? With this discount rate. go through this discount rate, right? So you start with the risk-free rate minus the dividend yield, right? And of course, you recognize right away why the risk-free rate is there, because again, it's risk neutral valuation, right? But whenever we receive the risk-free rate, it means we lose the dividends, so we subtract the dividend yield, right? And then minus half of the variance of the underlying stock, and the whole thing times the length of the step, right? Like in this case, we're gonna use 1 day, so it's basically 1/252 in terms of a year, right? So that's what delta T is gonna be, right? And then class, so this is why it's a Monte Carlo simulation, because we have this term. Okay, let's check this out, right? So we have time and class, the standard deviation, nothing spectacular, times the square root of the length of a step, nothing spectacular, but then here it is, times z. Z is a random value from a standard normal distribution. So you guys see what's happening, right? So we will of course start with S0, which is the value of the stock now, right? We're gonna make projections using this equation. Every time we make a projection, each day's projected stock price depends on this expression, which depends on a particular random value, right? And that recognizes the stochastic nature of this process, right? Any questions about this? Right? And again, actually, this is the assumption that Black-Scholes did, except they used it for European options. We're going to use it for American options. And by the way, like I said, do we have to actually use this? No. We could use any stochastic process that we think fit better, right, with that particular asset, right? So this is used a lot for stocks, right? Maybe if you use some other assets, maybe oil. Oil right now, oil prices does not follow this. So this, for example, this is a very smooth, will produce a very smooth simulated path. If it's oil prices now, you can have jumps. This does not have any jump. So you have to use it, and you have to change it, right? Any questions?
Yes, Professor. Yeah. So that's a big one, because not using the Black-Scholes model to value an American option, because the Black-Scholes was specifically made for European option, and also because of the American options can be exercised within the period of time.
Yeah.
So taking for this option, this related option valuation now, can you use it to value extended exchange product, like commodity as we are talking about?
So you can, but you have to remember when I say Black-Scholes, we're not actually using the Black-Scholes model itself.
Exactly.
We're using one assumption that they've made, which is how does the underlying price proceed in time, right? But we're not using anything else, right? So this has nothing to do with the fact that it's an American or European option. This is just a projection of the stock price, right? Does that make sense? And then what I was saying is that yeah, you could also use this instead of calling it S for stock, you could use it C for commodity price, something like that. But it would be exactly the same equation. That makes sense, right? And then I'm saying also that some underlying assets might not fit this description. Then you have to change it basically. But the other fact I was pointing to is make sure that part of the equation makes it a stochastic process. That literally the next value, which is on day j plus 1, is a random value from this equation. Right? That's what it says. And this is why we can have thousands of simulations with totally different paths. Right? But yes, you can use it for commodities or anything else. Right? Any other questions? All right. So here's the algorithm. Once you've generated thousands of paths, right, and that's easy to do on a computer, right? It doesn't take forever, right? But you generate thousands of paths, right, of the stock for the stock price. Then you start at the end, and this should ring a bell because that's exactly what we did for the binomial model, right? Again, the difference is these paths that we're simulating, they're not intersecting with one another. They're just random, but within specific constraints, which is that they do follow a particular stochastic process, right? For a binomial tree, it's even more restrictive. It's only a binomial, probability distribution. That's it, right? So here, we start at the end. And let's say we're trying to come up with the value of a put option. So at the end, we know this is what happens, right? This is the final value, right? It's whatever, either the put option is in the money, then its strike price is the stock price on that particular day. Day M, that's the final day in the life of this option, or 0 if it's out of the money, right? That's it. And then you just work back from that particular step to the next step, and then the next step. Again, how do you go from that to the next step before that, and then the steps before that, etc. How do you do that? So here's the idea. Every step on a particular day, let's say day I-1, right? What you're trying to compute is the value, right, of that particular day. So what do? First, you compute the intrinsic value, also known as exercise value by the way, right? So you compute that, rings a bell, because we did this for binomial, right? We did this for binomial model as well. So you compute this, and you can also compute, and this will require some calculation, as you will see. You also compute on that particular day, day I-1. Let's speak English together here, right? On day I-1, basically, you compute the present value of the value 1 day later, right? Because we do it 1 day at a time, one step at a time, from the future into the present, right? So we compute the present value of whatever the value was on the previous day, right? But in theory, right, we would not know what the value in the future is in reality, correct? So what we're gonna say is that we're gonna do it based on whatever the stock price is right now. We're gonna guess, right? We're gonna guess what that value is based on whatever the stock price is on this particular day, I-1. So let's talk about that. By the way, that's the continuation value, right? So once again, there's two values on every node, and you reduce it to one because of course you have to choose the one that's highest, right? So, and then once you do that, right, you move up the from the future to the present. Then, like I said, once you look at day one, you just compute the present value of that day one, and that present value is, of course, your estimate for today, day zero. And since you have thousands of paths, you're gonna compute the average of those V zeros, right? All right, so let's talk about the continuation value. So the whole idea is this, right? You want to estimate the present value. If today is day I minus 1, you want to estimate the present value of the option, the present value of the value of the option tomorrow, right? So what we're going to do is basically we're going to run a regression that uses the stock price right now and the squared stock price now. We're going to use a regression, right, to predict this present value, right? That's the whole idea. And then once you actually have the regression and you have the coefficients A, B, C, you just plug it in. That's your equation. And if you know the stock price today, you just plug in SI minus 1 and SI minus 1 squared. And we are done, right? And so, this is just explaining the fact that there are two possibilities. If the continuation value happens to be greater, so the continuation value is computed by regression. This is what I was saying. You know, this is the one from regression. And so if it happens to be greater than the exercise value, then that's going to be the value of the option at that particular point in time on that particular path, right? Statistically, you want to use the same, like you want to, logically you want to use this formula also. Once you've decided that, yeah, it's greater or it's less, but for statistical reasons, really to reduce standard deviation of the estimate, instead of using the expression from the regression, let's just use literally the present value of the actual estimated value of the next day, right? So that's just a small detail. What I'm hoping you remember from this is very simple. We still have to compute exercise value and continuation value at every given point in time along a particular path. Right? These paths are not binomial, it's just a continuous path, right? Because they're simulated. And you have to compute those two values and choose the highest one as the value at that particular point in time, and then move back, right? Move back to compute the present value of that. Compare the present value of that with the exercise value. So the principle itself is simple. And so, if you look at the Pricer, called simulated Pricer or something like that, on Haskell CD, this is, you can have, this is just a screenshot from that particular tool, right? You notice that I plugged in exactly the same numbers that I use for the binomial model. There's only one difference, right? Number one, we have a choice of how many simulations we're running. So in this case, I chose 1,000. In practice, you should choose a lot more, 10,000 or 100,000. Right? But I have a laptop, not a real computer, so that's nice. So that's number one. And then you also can choose how many steps along each path. So I'm choosing, like most people, a step to be 1 day. So my assumption basically is I could exercise it once a day, right? I don't have that choice of should I exercise it at the start of at the opening of the market or at the end or somewhere in between, right? I just assume it's at the end, right? That's it. So 252 days, because there's 252 days of trading in 1 year, and this particular option, these options are 1 year old. And you guys hopefully have noticed that the numbers are fairly similar, which is very encouraging, of course, right? Because if you have a model like the binomial model, and then you have something like this, which is supposed to be more sophisticated, but then it comes up with a totally different values, something might be wrong, right? Like, let's say it's twice the value from the binomial. Because the binomial is very popular, it's used in real life, and so it is fairly accurate, right? So, anyway, bottom line is you can do this as well. One of the advantages of using Monte Carlo simulation is you can use the distribution that you generate because you have so many paths, right? You end up with a probability distribution of the stock price or the underlying asset price every day, right? You have a probability distribution, and then you have a probability distribution because you along each path every day you have a value for the option. So every day you can look at all of the paths and you have a lot of values for that particular option. Right? So you have a probability distribution. And what's good about that is that allows you, for example, to come up with risk metrics like value at risk, right? Which is whether it's simulated or assumed, it's always based on some sort of probability distribution, right? So let me, that's the beautiful formula I was telling you, right? That's the Bjornsson and Stansman for, well, you guys see that it looks somewhat like the what is it called? The Black-Scholes model. But because the American options are a lot more sophisticated and a lot more complex, obviously the formula is going to be complex. I'm not even going to go through it, but I can guarantee you that the next slides tell you what each one of these letters means, right? Now you do have a Excel calculator that I've posted on AskCT, and the formulas are in there, right? And obviously you can guess. There's no way I was gonna input this manually, and you have to do it through code, right? So, and of course we could have computed it through code actually, but I didn't want to do that. I wanted to show the formula, right? So that's the formula. Maybe a couple of things that worth noting. So I was saying that it's an approximation because they assumed that there's gonna be 2 points in time when it's optimal to exercise the option. So the first point in time, the stock price is greater than I1, which is a trigger price to be computed. Then you exercise. And then the second possibility, when you're gonna exercise it, if the stock price is greater than I2. So there's 2 trigger prices. Right? That's it. Right?
Are those I2s are typos or?
No.
I
They're,
mean, 2 times.
yeah, it's 2 times just because the formula, when you implement it, right, it's easier to enter it because basically the idea is you need two
No,
things
that's
here.
what I mean.
I understand. Yeah, it's just done on purpose, right? Good question. So, all I can point to you is, okay, if you want to know what I1 and I2 are, what the stock prices that would trigger exercise, here they are. Depends on B0, B infinity, and H1 and H2. Above, you have the definition of B0 and B infinity, which depends on beta, and then you have a definition of beta, and then you have a definition of H1 and H2. I'm just convincing you that this is a complete set, that there's nothing missing there, right? That's basically what I'm trying to convince you on, right? But, you know, I like this because it tells the world that we are hardworking. to have to, not just to have come up with it, but actually have to use it every day. All right. So hopefully you guys recognize things like D and D2, right? It looks a lot like D1 and D2 for Black-Scholes with a log of S over something plus, you know, it looks very familiar, divided by sigma square root of T, right? And that's the point, is it turns out when you make that assumption that there's gonna be 2 trigger points, then you can make it look similar to Black-Scholes, but of course a lot longer as a formula, right? Yeah, so in that particular formula, you have these functions, phi and psi, right? So these functions are defined here. This is, I should say, phi right here. It's not that complicated actually, right? Psi is slightly more complicated. Slightly longer, but you can handle it, right? By the way, M, so you see a lot of M in the expression for psi. M is instead of the standard normal distribution, which is for one variable, right? This is the joint standard normal distribution for 2 normal variables. Right? So so-called standard bivariate, because of 2 variables, bivariate normal distribution. Right? It's a formula. It's exactly under the same assumption as Black-Scholes, except that it's an American option, so you have to say, okay, when am I gonna exercise? And so they assume those 2 that there's 2 points in time. That's why it's an approximation. Lambda, good question. As defined in the 5 functions, let's see if that's true. Of course it is true. It's just here it is. Here's lambda. letters are defined elsewhere. Good question. So do we have to come up with a different formula if we do put options? And it turns out no, you can use exactly the same formula. Just change the input variable. That's what I've just surrounded with that red thing. In English, all I'm saying is that if you want to compute the put value, an American put value, you use the same call formula, but you change the inputs, right? So for example, the first input is the strike price, whereas when we actually use the formula for an actual call option, the first input is the stock price. You guys see that, right? So that's the idea. All right. Now that you're familiar with it, and again, I don't know, maybe I should do that. Let's see if it's worth it. So the formula is in the, and let me show you where the formula is. You're gonna have to customize the view. Because I don't have that developer tab, so sometimes when you look at a formula that's implemented by code, you have to look at the developer tab. So there it is. I put it in the developer tab. Look at Visual Basic. Yeah. There you go, right? So, in this code, you do see everything that we've defined, right? Because you're not gonna catch me implementing these by hand. There you go, that's on. That's the whole thing. It looks much better as a code because it's short, right? But that's the idea. All right, let's see.
So just like the,
Yeah.
just like the volume function, does it also have those assumptions also, the setting?
Yeah, that's a great question. Yes, it's got exactly the same stochastic assumptions, geometric Brownian motion. It's exactly the same thing that Black-Scholes did. And you know, all of finance really, since Black-Scholes, have been dominated by that assumption. Why? Many reasons for this. The main reason is that it's the simplest possible stochastic process that's close enough, not really true, but close enough to describe what an actual financial asset price does, right? Because if you look at other assumptions, for example, you have process with jumps, things like that, and that makes things more complicated because automatically there's more variables to estimate. Right? That's a great question. Yes. So it's got exactly the same assumptions. The difference, of course, is this is not a simulation. This is a formula. So you just plug in the numbers as opposed to having to simulate it and yeah, right? Okay, so I'm using exactly the same inputs that we had for the binomial model and the Monte Carlo model, right? Exactly the same input, and you guys see this, right? It's very similar, very similar. Why is that important? Because again, it's reassuring, right? You do not want any significant difference, right? If there is, then you want it. You know, because we're using very similar assumptions on how the stock price moves over time, right? We should have very similar results, and that's exactly what we're getting, right? And so when you compare, just as on a table, just to show you, this is what you'd like to see. And in practice, you want to use more than one model, just like we're doing. Because every model is a model, it's just an estimate. You do not want to come up with just one estimate, or at least use one method to come up with an estimate, right? So I think that's it. I conclude, I'm hoping, let's see. Yeah, that concludes the pricing story. And hey, we might be lucky that we're actually be finishing earlier today. Any questions as far as the pricing models are concerned? Just to recap, right? So for European options, we know at least the binomial model and the Black-Scholes model. And we should know the assumptions behind each one of them, right? The obvious one is when we make projections of the stock price, the binomial model assumes two possibilities every step, right? Whereas the Black-Scholes model assumes a normal distribution every step for every step. So there's an infinity of possibilities, not just two possibilities, right? So that's critical. So we have those two models for European options. That's way more than enough, right? Having a formula in itself, that's really the holy grail right in finance. If you have a formula, you just plug in numbers, you're happy, right? And so that we have that for European options. We have some sort of a formula for American options. It's a long one, complicated one, and it's an approximation. It's pretty good, though. And that's why it's used actually in practice. So if you use Bloomberg, Morningstar Direct, or other platforms like Thinkorswim, for those of you who have a brokerage account on Charles Schwab, they all use at least the Bjornsson Stensland model and the binomial model and the Black-Scholes model. Right? So there's at least those three always on all platforms. Right. And sometimes they use Monte Carlo as well. Right. So we have binomial and Black-Scholes for European options, and for American options we have three, right? Binomial, Monte Carlo, and essentially the Black-Scholes version of the American option. They even have the same initials, right?
So in terms of confidence, can you say that Monte Carlo is more accurate than
Well, I mean, it's definitely richer. The Monte Carlo is richer because you make a lot more projections, and you're not the assumption of the stock price moving forward is not as restrictive as the binomial one, right? For example. And in terms of exercising, we're not forced to exercise only at 2 points in time. So absolutely, as far as which one is the best in terms of more versatile and more realistic, the Monte Carlo is the one. But for that, yeah, there's no way, there's no formula because it's a simulation, you have to code it, right? So that's the idea, right? And what if you understood the algorithm that I just went through? That's what you have to code. And nowadays, with large language models, as long as you have a good algorithm, they do a good job of converting it into any coding language. Right? But you cannot just say, do this in English. No. Then you're gonna spend forever. But if you have an algorithm like the one I just showed, then you can translate that into actual code. Right? Fast is what I'm saying. It's always possible to get code, but if you want to stay half day in front of your computer, yeah, you can get code. If you just speak English, it doesn't work that well. Anyway, yes. So let me repeat it. That's a great observation. So the Monte Carlo alternative is the best in the sense that number one, the assumption of how the stock price moves over time is not as restricted, because every day there's an infinity of possible values opposed to just two values when you talk about binomial. Of course, the BS model on the right also assumes that there's an infinity of possible values every day for the stock price. So in that case, they're equal. But there's a big difference, which is the Monte Carlo simulation allows you to exercise at any point in time, at any day within the life of the option, whereas BS allows only two possibilities, right? And so that's a big difference. So yes, the Monte Carlo definitely is you would expect it to be the more accurate. But you notice that there's not a whole lot of a difference between the three, right? So, other questions about it? Okay, so let's start talking about hedging, and I want to check my So, recap on the Greeks, and then you're gonna say, what? We didn't go through so many Greeks. Absolutely. You're right, we didn't. But I thought I would add more of what sometimes, not necessarily frequently, but just sometimes is used, right? So we talked about delta, and I go back into what that means, obviously, because it's a recap. So we talk about delta, we talk about gamma, we talk about theta, vega, rho. Then there's some new ones. And we talk about those, but these are basically 4 additional Greeks, right? We call them Greeks just because most of the letters are Greeks. This is for different. He's going to say, this is not Greek. Which is right, of course, but hey, people call it Greeks because the majority of the letters are so the new ones are lambda, vana, Volga or Vama, and Char. Right. I've never heard of a letter called Char. Okay. Anyway, so let's go into what these are, right? Because all that's required of you is just to have a conceptual understanding of what each one of these letters is supposed to be measuring, right? That's it. If you have it firmly in your mind, the rest is going to be very easy, right? So let's go back to delta, right? So what is delta? So delta is a measure of how much the derivative price will move if the price of the stock. So I'm going to say stock, but you guys understand it doesn't have to be stock, right? The underlying asset could be anything. But if the price, by how much will the derivatives price move if the price of the stock moves by $1, right? That's the idea. It could be moving up or moving down, but let's say we simplify it, we're gonna say move up, right? And so that's the general, so what you need to also remember as far as Greeks are concerned, so we start with delta, so it's a great opportunity for me to remind you of that. When you measure delta for anything, it's the delta of 1 unit of the derivative, right? So, when you say delta for a call option, it's for 1 call option, right? And if you want the delta for 10 of the same call option, you multiply the delta by 10. Does that make sense? Right? That's the whole idea. Because you want to measure the change of price. So, if 1 call option, let's say, moves up by $1, then 10 call options total moves up by $10. Does that make sense? So, I just want to make sure you understand this. Now, technically speaking, so maybe I should show you before going on. So, probably did. So actually, this is an older version that I'm showing you on the screen for the binomial. But if you go on, ASCII City, you will see that there's the Greeks, right? Can someone confirm this? Right, if you download the one on, and maybe I can see it here. Let me do that. Let me try and do something here. We're gonna go,
What's the name of this file?
just binomial option pricing, something like that. I can actually, let's do that. So what I'm gonna do is just download it from ASCII since I don't have it. Yes, this is not. Let's do that. so we do have estimates of the bricks as well, and that's feasible only because we have that tree, and we have the value of the option, at every node of the tree. So for example, delta, let's see if we can figure it out. I'm not gonna spend too much time on it, but yeah, 107 minus 106. Yeah. 107. So the value of the option when it's up minus the value of the option when it's down on day one, right? Divided by the stock price, or so I should do F2 maybe? Yeah. So the value of the option on day one when it's up minus the value of the option on day one when it's down divided by stock price when it's up minus stock price when it's down. So literally, because we have a tree with two possibilities every day for a particular node, you can easily compute the delta. So that's the whole idea. In the same way, I just want to show you that we can compute, and it is computed in this prices. So here for Monte Carlo, delta, it's very simple. You try it for a particular stock price, and then you try it for a slightly different stock price, and then you compute the ratio of the difference, just like we did for binomial. Same story, right? And so you have delta, and then for let's see. And then for Yerkes, you compute delta just by, it's a formula, so you can take the derivative. That's literally the meaning of delta, right? It's derivative of the call value with respect to the stock price, right? So that's how actually these values are obtained. It's literally calculus, not simulation rate, right? And again, the concept is, oh, sorry, Peter, were you still?
No, I'm good.
Yeah. So the concept is, yeah, change the underlying stock price a little bit, and then see by how much the option price changes, right? And that's exactly what we did in all of the pricers that you have on ASCII, right? Now, what is gamma? So gamma is the change in delta when the stock price changes by $1. So why is that interesting? Well, for those of you who know calculus, and even for those of you who don't, you should know that every time we talk about change, right, and it's a derivative, it's really computing derivatives, it's whatever the result we get, it's actually for a small change. Let me put it differently. If the stock price actually changes by $1, the derivatives price will not change exactly by that. It will be slightly different. Because delta is supposed to be for very tiny changes. So what if you want to be safer because you predict bigger changes, right? Then you don't just want to hedge delta, you also want to hedge gamma. Meaning you want to reduce delta to zero, the delta of the portfolio to zero. But like I said, if the change in the stock price is too big, it's not going to be zero. You guys understand that? So one way of making sure it's closer to zero, it stays at zero still, is to hedge gamma. Why? Because you want the change in delta to be zero. So the delta becomes constant over a larger change of the stock price. Does that make sense? Right? So you want the change of the change usually to be zero, right? Because if you just want the change to be zero, it's gonna be zero, but only for a very narrow variation of the stock price. And so how do you compute this? Well, exactly the way you computed delta, right? But instead of changing the stock price and observing how the value of the option changes, you instead observe how delta changes. Does that make sense? All right. Questions about gamma? All right. So gamma is a measure of the change of delta when the stock price changes. You want to hedge it if you want to make sure that your delta stays close to zero, right? Delta hedging alone will not protect you against bigger changes. Delta alone will protect you against small changes, right? That's the distinction you should make in your mind, right? Then we have theta. And theta, we talked about time, right? Measures sensitivity of the derivative price to the passage of time, right? So this literally, instead of saying what if the option is longer, theta is really about the time going forward, so it becomes shorter. The time to maturity becomes shorter, right? That's the idea. So how would the value of the option change? Well, obviously, we know that the option, most of the time, if it's an option, it's gonna go down, but that's basically the idea. And how do you actually measure that? Same story. You do have to try, because you either simulate the option prices or you compute it by formula, right? Either way, you can simulate, in the simulations, you can see what happens to the options price a day later, right? So you can compute the difference, and that's gonna be theta. If it's a formula, then you change the time input, right? You change it to t plus 1. Same story. You see how the value of the derivative changes, and that change is called theta. So the way we define it here, we talk about with respect to time going down, time to maturity going down. Generally speaking, you would expect theta to be positive or negative.
Theta is always negative.
Why, Cliff? You're right, of course, but why?
Because there's less chance for the option to be
That's it.
exercised.
Right? Basically, it's like the option getting shorter, right? Previously, we talked about this, talking about time. Like, if it's longer, then it makes the option more valuable. But actually, the way it's defined here, we make the time shorter. All right. The next one is vega. Actually, I didn't have time to. So, Cliff, what is this? What is this? It's not Greek, but what is it?
Vega is a stock.
No, but it's just made up. I'm talking about the letter itself, vega.
Yeah, it's not a Greek letter.
It's not Greek, I know. But what is it? We don't know, right? It says totally made up. Sounds good. Let's call it that. Well, it makes sense. You know why? Because it starts with the V.
Volatility.
And yeah, has to do with volatility. Right? So the whole idea is what happens to the price of the derivative if volatility goes up by 1. That's it. Now, we know that in general, it's going to increase the value especially if it's an option of some sort, right? It's an increase in the value. And same story, literally, if it's a formula, change the sigma, right? Like in the Black-Scholes formula, right? We have a sigma, change it by 1, and see what happens to the result, right? And that's Vega. If it's a simulation, same story once again, right? You guys remember, for example, Monte Carlo simulation, there was a sigma in the description of the geometric Brownian motion, correct? Change it by 1, see what happens, right? So that's the general idea. So why are we interested? So, okay, first of all, we talked about delta, and technically if you're gonna hedge, other than just using the covariance structure to manage risk of a particular portfolio, you can add a layer of hedging by using derivatives. And if you're gonna do that, the first thing you do is delta hedging, right? If you wanna be even safer, you have to do both delta and gamma hedging, right? And then you can do additional things depending on the risk budget and how safe you want to be. For example, if somehow you don't like the fact that, let me rephrase that. Maybe over time your portfolio for some reason will go down because of time. I don't know, it depends on what the portfolio is, right? What's in the portfolio, right? Maybe part of your portfolio is a lot of options, so their value will go down for sure, right? So you may, if you don't like the loss of value, then you want to hedge theta as well, right? Now, it is also, theta is not usually hedged, but it does happen, right? On the other hand, Vega is often hedged, volatility. So the idea is not so much, and this is where a lot of people misunderstand Vega. It's not so much that, IBM all of a sudden became more volatile, right? Yes, this is how we're gonna measure it, but when do you actually use that stuff? When do you use Vega and when do you hedge Vega? You hedge Vega when you expect what's known as a regime change. So maybe there's a time, a period in time when there's no wars, and then there's a period in time when there's a war, right? So these are two different periods, right? And clearly, they should have different levels of volatilities, right? As far as financial return and financial prices are concerned. That's where you use Vega, right? If there's war and there's clearly a different regime of volatility and you want to hedge against that, then you can hedge Vega, right? If you don't expect such a strong shift, right, in how financial prices will behave, you don't need to hedge Vega for sure. But again, it's something that's done. One thing also that's done, especially if your portfolio has a lot of fixed income, is hedging growth. Why? Because you don't like it when interest rates go up. Why don't you like it? Because the value of your portfolio goes down. It's very simple, right? Yeah, right? The value of any bond will tend to go down. Present value of the coupon plus par. Coupon and par don't change. That's in the numerator. The denominator, which is the interest rate, goes up. So sadly, the whole fraction goes down, right? The whole value, right? You don't want that. So you want to be ready for it, right? So one way of doing that is you measure growth. By how much will my fixed income, and I'm saying fixed income, it doesn't have to be fixed income. Obviously, stocks also could lose value when interest rates go up, right? Why? It depends on the sector, right? For example, the banking sector will be very happy when interest rates go up because their revenue goes up faster compared with the cost for them. And sadly, for most business companies, it's the other way around, right? The cost of financing, the cost of capital goes up. That's not good news, right? So that's why you measure ROE. I don't want to make it sound like it's just good for fixed income. But fixed income is a spectacular example. And you want to measure it and therefore possibly hedge it, because if the sensitivity is big, right? That's the idea. So again, same story. If it's a formula, change the risk-free rate by 1 and see what happens to the formula. If it's a simulation, same story, right? For example, binomial, you guys, we compute present value, right? Every step. So change that discount rate by 1 and see what happens. By 1% and see what happens. Right, so that's ROE. Let's talk about these other ones. So we're not gonna compute them, but we need to know that they do exist and we need to know what they measure, right? And then we'll take over it. So let's start with lambda. So lambda is somewhat similar to delta. It's a measure of change in the derivative price compared with the stock price, but instead of the dollar price, it's the percentage change in the dollar price, right? So if the stock price goes up by 1% instead of $1, what happens to the call price? Instead of saying it's gonna go up by $0.9, you say it's gonna go up by, I don't know, 0.2% or something. So it's in percent, right? But can we then, do we have to compute this separately from delta? And the answer is no. Here's the formula. So lambda is delta times whatever the stock price is divided by the option price. That's it. You guys have noticed, right? Because that's percentage. Delta is what? Change. Let me write it down. Right? So delta is change in the call price divided by change in the stock price. And then this says multiply this by the stock price divided by the call price. Yeah, because this is percentage change in the call option, and this is percentage change in the stock price, right? So you don't have to re-estimate anything, you just compute that, and that does it, right? Here's something that's interesting. VANA. Can someone check if that's real? Do we have something? Do you have an error called VANA? Just ask whoever, whatever AI you have at hand, they can answer it very quickly.
It's not a Greek letter.
It is not, right? I don't know how these folks have come up, but it's okay. It's okay, we'll handle it. So, VANA, what is VANA? It's a measure of how delta change when volatility change.
Partial derivative.
Yeah. Right? So how do you measure this? Well, you guys heard me talk about how to measure delta. Well, remeasure it, just change sigma and remeasure it. And whatever that changes, that's VANA. Right? Would we want to hedge? Oh, here's a question for everyone. When would you want to hedge VANA? If you remember the answer to hedging Vega, then you're going to be able to answer the question about VANA. When would you want to hedge? Everett, it looks like you want to say.
Is it not the change in the Vega that VANA measures?
Yeah, that's it. So it basically the change in volatility, right? If you suspect a change in regime.
Yes.
Because folks, it's very rare that stocks change volatility just like that for no reason, right? Usually it's the whole market that does that.
So is that also the
That's
first-
exactly it.
Yeah.
That's it. So if you suspect that there's gonna be a change in financial price regime, because maybe there's gonna be another war, or no more war, that's also a change in regime, then you also wanna hedge. You may wanna hedge Vega and Vana, right? That's the whole idea.
So can I also refer that one to as regime switching?
Yeah,
Okay.
absolutely, right? So if you, for example, if you hedge Vega, basically you minimize the variability of the derivative, right? But if you hedge Vana in addition to Vega, you don't just minimize the change, but you minimize the change in the change. Just like combining delta and gamma hedging, you may want to combine Vega and Vana hedging. And it's very easy to remember, they're all V's. Right, so there. You may do worse. Actually, you could do the third one. You can hedge Volga or Voma.
It's supposed to be Russian.
Yeah, must be, definitely. And how do you know that you combine Volga with Vega and Vana? First of all, you start with a V, that's a joke. But more importantly, it measures how Vega changes. That's why. So if you're gonna hedge Vega, again, when you hedge Vega, it's only for small changes of the stock price. As soon as the changes are bigger, then you're dead. So you wanna pipe on an additional layer of insurance, right?
It's gonna be like yes, second partial derivative.
That's exactly what it is. That's exactly what it is. It's the second partial derivative of the, what is it called, the option price with respect to volatility. Because Vega is the first order derivative, absolutely. Right. And that's the whole idea, right? The idea is that for small change, the first order derivatives are okay. But then if you expect bigger change, then you should add on second order derivatives. Right. Let's, it's a good time, so what I was gonna say is, we're gonna, talking about charm is a good time to stop, this particular part. What is charm? Change in delta over time. Right, so as time goes by, time to maturity goes down, delta will change. Right? So if you want to be foolproof with delta, then you do delta hedging combined with gamma hedging and charm hedging. Make sense? Right. So when you come back, we're gonna look at a specific example and walk you through an example where you're gonna try and combine, all kinds of hedging, and that's the idea that I want you to use for your next assignment, which, like I said, I will be posting that sometime tomorrow, right? All right, folks. So that clock doesn't work anymore, but I have 8. So let's all be back here at 8:15. Right, just add 15 to whatever clock you have. You'll be fine.
Could you share a bit about the assignment? That is a group project or?
Yeah, last group project. This is the last group project, and all that I'm gonna ask is once we go through what we're gonna be going through, I'm just gonna ask you to apply. First, you have to make a choice in terms of what sort of hedging you wanna do, and based on those choices, you're gonna use the steps that we're gonna.
How about the individual projects for the final?
The final would be an individual project, but it's not, you know, this is still, I want this to be group project, right, for sure. It's easier as a group, at least for real groups, it's easier, and then if you have to do it individually, I'm not saying that that's the final exam, but if you have to do it individually, at least you've practiced once, and, right, that's.
So, from now to the end of this month, you're gonna have 2 assignments,
So, one group assignment and a final exam.
exams or individual assignments?
The exam is just a project, it's a simple individual assignment, yeah, not like a
Like that
question.
multiple choice.
No, not like that. It's just an assignment.
Is it during the class time or it's like we have like a couple of days to finish?
No, you have days. Yeah.
Kristen. So tomorrow, at noon in the G theory or something.
Yes.
And after that was it?
We should go straight from here to Michigan.
What time should we leave? What time should we be there?
How long does it take from G to Michigan?
Where are we going?
Park Avenue.
What was the address? Tell us something about it.
277 Park Avenue. And the location of G's is 47 John Street.
That's fine. Yeah, we will go to one together to do something, but don't really care about GD. So it's 1.5 hour to go to that. Okay.
1.5 hours. That event start as 5:45.
5:45, maybe work for us?
I mean, it started at 6 p.m., but they started registration so that we check in from 5:30. So we should be there around 5:45 or 5:50 or something, just in case we don't.
I have to also park my car.
Yeah.
I mean, can go to hopefully the next one. So what time does the GE do? Is it 9? Or should be a little earlier, like 45 or something like that. Because also my car is in great shape. My honey couldn't get oxygen sensor.
Yeah, before it's not working, that's when we should start. We leave it or as long as this one is on.
So this is a GE room?
This is the.
And 5:45, 5:45 starts. So we want 5 to we have to leave around 4. Even 3, 4, I will think.
Yeah, 3:45 is fine.
Yeah. Is it really like a fancy dress or like what's the dress code?
Professional. Okay, see you tomorrow, yeah.
Yeah. And it starts at 12, right? At G.
How many questions are there?
Again, just to be sure what's the address? I have that.
Yeah.
Just what? Oh, is it the relay? Is it cool?
seen here in Ghana.
Place.
Here, it's nearby here, it's nearby Asafo Station.
See the Coachella?
Yeah, it's here, right? It's-
Oh, yeah.
Yeah, yeah, yeah.
Yeah, okay.
Yeah, I heard it's gonna be a little lower.
Are you
So
reaching
hopefully for
just
like an
now
artist,
after?
you can buy like artist,
Actually, yes.
wristband or whatever. Yeah. Yeah, bro. It's like hundreds and thousands. For them, it's fine now. For Coachella. What's next? Ray we going to? You sent me that link, right? How much were the tickets? June? Is that the closest one you're going to?
Chopping palm or something. I would buy for the. Still need anything. I went to how are you? Freaking friends are like they go to the other party and they didn't expect the buffet.
So I'm gonna be able to be free on the weekend. I might come to the, I might come to the
Like why
wristband.
it's got people's pain and it's then some of them like the raise they cannot accept they cannot accept options of the action. They deny it like oh this thing
I'll
is
just have that as back.
you president to the idiots cannot accept next.
Huh?
You know how you do action.
Right around the same. Trying to help my dad.
They brainwash, even really smart ones, they brainwash.
Some sort of
Realizing what they are it's very important.
we saw it, it's all the way down. It's the same thing.
Yeah. Door right there.
The two third, actually, he did the whole election system, but because he wasn't the first one, it worked against him.
Yeah.
He lost his props. He really did.
What I like about Ray full support of fans, etc.
Yeah, and
expensive.
that's what during the year, there was this and then saying, okay, one of the reporters, okay, so what happens if not all of the support we say, so are you going to support the president? And Ben say, hey, I'm of course I'm going to support one political president, one of them like, but the funny thing there, like, how do you feel in the election? And Orban was showing, and nobody showed it, only the US media, and that's they brought it over. So actually, even wasn't sure enough to the saying, oh, you is not going to win. Freaking bullshit. And yeah, it's really good news for everyone.
Well, yeah.
I mean, you are friends. Even I was in actually a foreign study trip in Rio. And there was one guy, like, in the lecture about international politics. Honestly, I don't know, he didn't get actually the magnitude of this. And I asked him, okay, what are the checks and balances for that situation? It's an authoritative leader like Orban is right. How can they stop him? And he said, oh, no, Hungary is not really a significant country. I didn't want to challenge everybody. It doesn't matter how significant financially, the same vote like everybody, but then he votes against that. I mean, I don't know, he didn't get it. He was actually teaching political science, but he didn't get the idea. I mean, I didn't want to challenge him. But luckily now, but actually we have to somehow change that system because what authority leader to rise like him, the system is kind of paralyzed. We have to kind of come up with some.
I think they will learn.
Yeah, I have to change some of the rules. I think there should be like a 2/3 majority or something like that. So one, you know, what they say, protesting vote that shouldn't block it. So I'm happy. But it's also a problem with some of my friends. They're so brainwashed, they can't accept it. And I think, oh, you will give me a check, some of them will stepping road and like, they're arguing with personal, oh, like idiots, and no facts, like pushing them to fact, and then after, like, they cannot stand it and step and leave the check. But before that, we stand there for 16 years. Okay, maybe the first year was 10 plus years. Like one of the guys who was he's an English showman, person, holding showman. He owns 1/4 of the whole Hungarian GDP. In the meantime, the GDP increase is 0.
I didn't know that was feasible.
Yeah, I mean, so was it not visible? Normally, his asset quadrupled each year. 1/4 of the GDP. Just even financially look at it, it's impossible.
Yeah.
And the guy even gave it. He's a farmer from his village. Ridiculous.
All right, everyone. So let's get started, right? So we're gonna start with this simple situation where we've got 1,000 shares right here. And that was the recent price, 240. And that's basically what you're gonna try and manage from a risk point of view, right? So first of all, let's make sure we're all on the same page. If you're protecting something, let's say a particular stock position, right? One share of the stock, if the price of one share of the stock goes up by 1, hear me closely. If the stock price goes up by 1, then the stock price goes up by 1. Meaning the delta of one share by definition is 1. We all agree? Right? The delta of one share is 1. So automatically, if we've got 1,000 shares, then the delta of the whole portfolio is 1,000. Correct? Right? Questions? Form your do you have a question? No?
Just like
Okay. Yeah, and we're going fast, so you could stop me by asking a fake question, and that will do it, you know, just ask a question. But anyway, so I'm just saying delta of a particular share of a stock is one. You know, if we talk about protecting your holding of that particular stock, later on things will be more complicated because instead of protecting one stock, we're protecting multiple different stocks. Each stock has a delta of one with respect to itself, but not with respect to the average, right? So we have to take care of that. But right now we're dealing with a simple portfolio, it's just one stock. So first thing we have to be convinced of the delta of one unit of a stock, one share of stock is one. And therefore, if you hold 1,000 shares, then the delta of that portfolio is 1,000. Are we all clear on that? Yes? All right. So then, our objective, right, with delta hedging is to reduce these to zero. That is the idea. Right? So there's no other way of doing this. Well, if we're gonna use derivatives, there's no other way of doing this than finding or choosing a particular derivative. So let's call it D1. Could be a put, could be a call, could be anything. Could be a futures contract. But basically the idea is that this derivative should have a delta called delta D1, right? And that delta, of course, is with respect to the stock, right? That particular delta is the answer to the following question. If the stock goes up by $1, what happens to the value of D1, that particular derivative, right? But it's the same stock, right? So actually the stock we're talking about, it's IBM. So this delta for the derivative is with respect to IBM. Do we all understand this? Right. And so naturally, although you don't have to, but naturally you would think of an option on IBM stock, right? So if you go on StockTrack and you look at investing research, one of the menu items is option chain. So if you type in the name of a stock, it gives you all of the options available on that particular stock, right? For a particular maturity date, and if you want longer maturity date, you can have that as well, that choice on the screen. So the whole idea is this. How do we reduce the delta of the portfolio to zero? Well, you start with the portfolio and you add X unit of the derivative. So now the delta of that derivative becomes X times delta of D1. And you want the sum of the deltas to be zero. That's what I mean by reducing the delta to zero. Questions about that? Right? And we're gonna call this the delta equation, right? Because literally it's the sum of the deltas of all of the positions you have, and you equate it to zero because that's your objective, right? So in this particular case, I'm gonna choose, just because it's a well-known strategy, I'm gonna choose to buy a put option on IBM. Why? Because the delta of a put option, we know this hopefully, is negative, correct? So if we buy it, since the delta of the IBM position is positive 1,000, if we buy put options, enough of it, we're gonna reduce the whole delta. Does that make sense? right? That strategy is known as a protective put strategy, right? When you buy put options to protect a particular portfolio of stock, of shares, right? That's a protective put. It's also known as portfolio insurance, but actually everything we have talked about is portfolio insurance. But that's like the prototypical portfolio insurance. Every time you hear that, people think in terms of buying a put option, which is the insurance policy, right? Please note the following. Right? So this is a protective put strategy or position, or whatever name you want to put it. And the reason for this is because the delta of the put is negative, right? Before I go further, I want to make sure you understand something else. Is a long position in a put option the only possibility with a negative delta?
Sell a call.
You could write a call. Because the delta of a call, a long call is positive, correct? So automatically the delta of a short call is negative, right? So I want to make sure you understand that, right? I just chose this particular strategy to illustrate what I'm about to illustrate, but I could have done some other way, right? We could have chosen, I should say that. Or we could have chosen to write call, which would have given us once again negative delta, right? And instead of calling it protective put, this is known as covered call. This is a covered call strategy for covered call position, which is covered call. Right? There is a distinct difference, even though the deltas are negative, there is a distinct difference, right? When you buy put options, you pay for it, correct? When you sell calls, you receive revenue. I go back to this issue. Sounds good. Not necessarily. The revenue you receive when you write a call, that's actually the maximum insurance money you get. You get the insurance money up front. That's it. It's not free lunch. That is it, your insurance money. So it's limited to that. Questions about that?
Isn't the covered call more risky than the protective put?
Yeah. And we'll get into that.
Yeah, because
But-
we won't control.
Yeah, but that's the point, is that I don't want people to be happy because, hey, we hedge and we get paid. No, you don't. What you get is the insurance money. You didn't get paid. You get the insurance money, but you're not fully hedged. You're never fully hedged anyway. This is a little bit worse. We'll get back to that. In this example, we're going to use put options, okay? So, like I said, on StockTrack, you go on investing research, then you click on option chain, and then if you type the name of the company. So by the way, so since I'm on this topic, you can have options on individual stocks, but you also have options on indices like the S&P 500, for example, on StockTrack. You can have options. If you don't like the indexes themselves, you can use the ETFs on the index, right? So you can have options on the ETFs on StockTrack, right? And by the way, everything on StockTrack does exist. It's not like a made-up thing. These are actually, right? The difference is you cannot trade for real. That's the difference. But I just wanna make sure you understand, it's not just, options on individual stocks. And that distinction will become critical later today. Okay. Something else? The one that's very obvious, and so sometimes you might be tricked by that, is that they highlight some options, so that's all you see in their short-term option. Actually, on the same screen, what's the word? Low lighted, literally, you actually find the longer term options. So I don't want anyone here to say, oh, I can't do it because there's only short term option. No, you actually have long term options as well, right? And it looks something like this. So here, we're going to be using, so this is on the option chain for IBM, right? And I chose a longer option. That's the options that expire on March 19 of next year. So that's long, right? That's long enough for us. We're gonna choose, so the price of the stock, you remember, is $240. So a typical routine way of doing this is you choose a deep out of the money option. So, right, so let me show. So the price of the stock is around 240, right? We're gonna choose like the lowest possible strike price, which for a put option, as you remember, right? Put option is the right to sell. So we're gonna buy the right to sell at 200. Why not higher? What? Because I'm looking at the prices, so these are the prices, right? There's some significant differences there. Do you guys see that? So I want the cheapest. And so, and by the way, so that's why it is routine, at least to start with something like that. Now, we want to, at some point, figure out the Greeks for that particular put option with a strike price of 200. We know the price is 17.50. This is per share. All of the real life option quotes are typically on a per share basis. By the way, that you mentioned. So it's on a per share basis. But very often, when you actually buy it, you find that the prices are multiplied by 100. Why? Because in most cases, when you actually buy or sell options, each option is not on one share, but on 100 shares. Okay? But for calculations, it's always best to think of derivatives on a per share basis.
Is this actually quoting because it's just $1 strike price increase or $2?
Yeah, so the strike price, there's different strike, but these are multiple options, right?
Was that strike price the first one which is circled?
200. I circled 200 because that's like the lowest strike price that's on the market. And the next lowest is 210 and then 220.
Okay, there is $4 difference. Okay.
Yeah, right. And so, to discover, so these are the Greeks for the call. And if you want the Greeks for the put, you have to click on this. And you're gonna get the Greeks right. Right? And so for this particular delta is negative 0.24, right? In English, if the stock, if IBM goes up by $1, the price of this good tends to go down by 0.24 down, 24 cents, right? So, okay. So let's choose that. We just strike price, put option with the strike price of 200. And like I said, it is difficult to choose deep out of the money derivatives because it tends to be cheaper as in the actual amount of money coming out of your pocket, right? That's what I mean by cheaper. Is it cheaper in terms of fair value? Well, let's see. So here's something that you should do. Actually, you're required to do it in the assignment. Every time you're considering a particular choice of a derivative, you should check if the derivative is fairly priced or not, right? How do you do that? Well, you have all of the pricers already available to you. Do you remember this, right? So it should be feasible to check that, right? In this example, we're gonna do it. Say again? Yeah. And actually, I just realized that my mic was off, so now it's on. So what I was saying was that we should always make sure that whenever we choose a particular derivative instrument, we check whether the price is fair or not. And by the way, just because it's unfair doesn't mean it's bad, right? If we're buying and it's underpriced, that's good, right? Or if we're writing the derivative and it's overpriced, that's good, right? So just because it's unfair does not mean it's bad or bad. All right, let's do it this time, and then I'm not gonna do it again because we're gonna add more derivatives. So this particular put option, I used both the PS or it's an American option. So PS and simulation models, right? And you know, this is the price of IBM. This is the strike price, 200. Right? And then I found sources for the 1-year T-bill rate, 3.71%, and sources for dividend yield and volatility. However, you don't need sources for dividend yield and volatilities because you already have the data with your portfolio, at least for volatility. Dividend yield, maybe you can find sources. But it's easy because dividend, you just look at the dividend for 1 year, divided by whatever the price is, and that's your dividend, right? So, you guys have noticed, one model prices the put option at $6.17, and the other prices at $6.54, right? And for those of you who did not pay attention, the price, the actual market price, is $17.50 right here. Right here. This is the actual price. What's your conclusion? How to overthink it? So the fair price is $6. The actual price is $17.50. So it's very expensive. It's very expensive. But look at the other prices. 21, 24, 29. It's even worse. You guys see that point, right? So sometimes we have no choice. We have to deal with what we're dealt with. That's it. Right? But clearly, this is very expensive, right? Questions about that? And that's the sort of a judgment you have to make, judgment call you have to make before you move forward. So, okay, let's move forward, that's what I was saying here. It's very overpriced. By the way, is it abnormal that it's overpriced when it's deep out of the money? No. Remember the volatility slide? The one that says, you know, at the money, options tend to be fairly priced. And then deep out of the money or deep in the money, they tend to be overpriced. And the deep out of the money explanation is simple. People buy insurance, a lot of people buy insurance. So they're willing to pay for that. Right? So we're gonna still buy it because there's a significant price difference with the other available options. So that's the sort of logic that would tell the outside world if asked, why did you buy this? Right? There's no other reason. That's the reason. Right? Okay. Here, I'm just telling you where I found all of the estimates for the other parameters of the model. But what matters is what do we do now? Well, here it is. This is the delta equation. Delta of the portfolio of IBM shares plus X, which is the number of put options we buy, times the delta of the put option equals 0, right? And when you put the numbers, the delta of 1,000 shares is 1,000 minus the delta of the put option is minus 424 times X. One equation, and we want that to be 0. One equation, we want to know. That's it. Right? So now we know we need to buy 4,167 put options. And that, you multiply by $17.50. That, my friend, is a costly, but not, it's normal. You have to pay for insurance. 73, almost $73,000 on a $240,000 portfolio. That is pricey. So now you're thinking about it and you say, oh, maybe selling a call option is not that bad. We'll talk about it. Right? But anyway, by the way, just a quick check. What is the delta of all of these? Oh, I should correct this. What is the delta of all of these put options? Well, when you compute, I forgot the minus sign here. It's negative 1,000. So you guys see what's going on, right? You have a delta of the stock, positive 1,000, and we bought enough put options to have a negative 1,000 delta from the options, and you put the two together, and you get a 0 thing, right? A 0 delta. So I've already mentioned this as an example of protected put strategy, right? Questions? If you understand this, you're gonna understand everything. You're gonna use the same idea, except you're gonna just pile on layers of derivatives. That's basically what's gonna happen. And you're gonna pile on layers of equations, right? Right now we have one equation, one unknown, because we wanna hedge one thing, which is delta, right? Any questions, anyone? Okay, good. Keep this going. So, all right, now, the only thing that could be wrong with these strategies here, it works only on small changes. What if you want to be, You want a more robust protection. So in that case, you can also hedge, not again, not just having delta of 0, but you also want the change in the delta whenever IBM goes up or down. You also want the change in delta to be 0, right? The second order derivative literally of the value of the derivative of the option with respect to the stock, right? So that's gamma, right? Changing delta is gamma. So what we want to do is have both delta and gamma of our portfolio to go to 0. Questions about that? Right? Now, here's some good news that by definition, since the delta of the delta of one share is 1, and the delta of the portfolio is 1,000 because we're 1,000 shares. The point is that these deltas are constant, right? They're numbers, right? 1 and always 1 and 1,000. So delta does not change. Meaning gamma, which is a measure of the change in delta, gamma is 0 for the stock. Questions? Right? Now, if you go to the data for the put option, you will see that the gamma of one put option is 0.00329, right? So if you multiply it by the 4,167 put options we've bought, that is a change of delta of $13, like $14. And actually, that might be very small compared with, the value of the portfolio. Maybe we shouldn't do anything, but because I want to illustrate, what you do next if you want to be more, if you want to be safer, then we're going to go forward, right? Like you guys understand that this is a judgment call, correct? Right? Because it's, what I mean by judgment call is normally if you do this in practice, there's like risk tolerance. So you are told you're not allowed this much loss or whatever, right? And so $14, I don't think it's a big maybe we should save some money on buying derivatives and accept a $14 loss. Today, we're not gonna do that. We're rich. Also, we wanna learn, actually, so we're gonna go forward, right? So that's the idea. So, what do we need? In addition to a delta equation, we now need a gamma equation. And we want that gamma equation to equal 0. Why do we need a second equation? Well, because we need a derivative, another derivative. Let's call it d. Right? Whose number that you need to buy or sell, we don't know. So there's 2 unknowns. If there's 2 unknowns, you need 2 equations, right? And that's one reason. But you could look at it the other way around. There has to be 2 equations because we need the delta to equal 0, and we need gamma to equal 0. Does that make sense for the whole portfolio? That's it. So there has to be 2 equations, whichever way you're looking at it. All right. So if you look at the call, so I'm not going to show you the table again, but on the same row, you have the call option, and it's got almost the same gamma. Instead of 0.00329, it's 0.00327. So that's promising, right? Because, there's only 3 things in the portfolio. There's going to be 3 things, right? IBM shares, whose gammas are 0, right? Then we're gonna have to put options. The individual gamma is 0.00329, and then we're gonna have to call options. And the individual gammas are almost the same. So that's promising. I mean, it's gonna solve our problem, right? All that's gonna happen then, because the options have the same gamma, is we're gonna need to sell the call option to have negative gamma. And that's good news, because the price of the options is $55, right? I have to scroll up very quickly just to show you. It's right here, right? This is the price of the option if you're gonna sell it, right? $55.85, right? So that's very promising. So let's do it. So, so here is the delta equation. By the way, I've put the portfolio REITs on the right-hand side of the equation. So they replace the zeros, right, that were there, right? But it means exactly the same thing. It says, the first one says, the portfolio delta plus the portfolio of the put options plus the delta of the put option plus the delta of the call option should be 0, right? Means the same thing, right? In other words, I just moved delta P to the right-hand side. Same thing with gamma. I'm saying the gamma of the portfolio of stocks plus the gamma of the put position plus the gamma of the call position should equal 0. Any questions about these two equations or the way they look? Like some of you might be surprised that it's not 0 on the right-hand side. It's because I moved anything that has to be a portfolio. I moved it to the right-hand side. Why do I do that? Because it looks prettier. You know, you have X and Y unknown, right? On the left-hand side. Actually, has nothing to do with looking prettier. It's just that you should see that it's a system of simultaneous equation, and you could use it as, like, you can use matrices to solve for it, which I'm not gonna do here, right? That's the whole idea. So, when I plug in the numbers, this is the delta from the put position, delta from the call, and this is negative delta from the shares. In the same way, this is the gamma from the put position, gamma from the call, and negative gamma for the stock. Any question? So that's it. Two equations with 2 unknowns. Why? Because we do not want to hedge one REIT, we want to hedge 2 REITs. So that's 2 equations. And in order for you to have 2 equations to solve, you need 2 unknowns. So you need one more type of derivative. So the more hedging you want to do simultaneously, the more different types of derivatives you need to do. Questions? All right. So, solve for X and Y. Here it is. We need to sell 1,032 calls and buy 1,026 puts. Right? These are the ones with a $200 strike price, expiration date March 19, 2027. Right? And just as a quick check, let's look at the delta of this portfolio of derivatives, right? So this is the delta from the short calls, right? Negative 1032 times 0.73. And then the delta from the long puts, negative 0.24 times 1026. And you guys see this, right? Look at the total delta from the derivatives. Negative 999.6, almost negative 1,000, which is good because we're trying to bring a positive 1,000 into zero. So this position in derivatives does help, right? And then look at the gamma. So the gamma from the short calls is negative 1032 times 0.00327. And the gamma from the long put is 1026 puts times 0.00329. And check this out, 0.0009, close to zero. So that's a perfect peg for the gamma of IBM shares, which is exactly zero. Right? You guys see it? So how much does this cost? Well, we're selling, we're buying 1,020 goods, but we're selling 1,032 calls. So we end up with a negative cost. In other words, we get a positive revenue of almost $40,000. And some of you will be happy with it because they're, wait a minute, we're hedging more rigs and we're actually making money. To which I say, hold on, right? It's not, things are not always as they seem. Yes, you do actually receive net revenue, but as I've mentioned to you, as soon as you short calls as some sort of protection, I was gonna say actually as soon as you short anything as some sort of protection, any premium that you get as revenue, that's the insurance money. And you're not gonna get more than that, no matter what happens. Do we all understand this? Right. So that's the idea. So actually that's what I'm expressing next. So earlier on, when we hedged, we just wanted to hedge delta and not delta and gamma, we could have sold calls, right? And we would have gotten revenue, but like I said, that's the insurance payoff, literally. You're not gonna get any more money than that. Here's why it's risky to do it that way. Not only don't you get more insurance premium if the disaster is worse than you thought, right? But it gets worse. If in fact the disaster happens, IBM goes below 200, right? You know what happens? You lose the whole portfolio because you sold a call option with a strike price of 200. So the other side has the right to buy, right? The stock at 200, right? So as soon as it's, we see that, right? So as soon as the stock price, actually this doesn't make any sense. I should correct this. The point is that we can lose as soon as the stock price is above 200, not below. Right. When the stock price is above 200, right? The other side has the right to take $200 for a whole portfolio. You guys see how it doesn't make sense, right? So we get the initial revenue for what? Because you're gonna lose your portfolio immediately, right? So that's the risky part of it. you get, it looks like you're doing well because you receive revenue, but the whole scenario might turn against you immediately, right? In fact, and this is the key, right? And that's where this is I misspoke here. In fact, the only time you're safe with this is when the portfolio, the stock price goes below 200. And that's what you wanted to be protecting against, right? Here's the thing, when it goes below 200, the other side will not exercise it, right? Because they have the right to pay 200. Why would they pay 200 when they pay less, right? So they're not gonna exercise it. You're safe, but you're not gonna receive money. The money is only the premium you receive when you sold the call option. Does that make sense? So it's a much riskier. It's hedging, but it's a riskier kind of hedging. Questions about that? Okay. So, and maybe, hold on. I just want to make sure that I have, maybe I can. So I just want to make sure you guys realize what the payoffs look like, and then maybe I'll add it to these slides at some point. So a protective put is what? You have the stock, so the payoff looks like that, right? But you buy the put option, so the payoff looks like that. Right? So you add these two, and you're gonna end up with a picture that looks like this. Right? That's the payoff of a protective put, right? So if the stock price is below 200, you're protected. It's gonna have a fixed price of 200 because you have the right to sell at 200. And then, as long as it's above 200, then it's as if you have your portfolio as usual, unprotected. So nothing wrong with it, right? So that's a protective put, kind of a payoff diagram. Right? This is payoff, and this is the stock price. What does the picture look like with a covered call? So covered call, trying to take advantage of any space I find. And this is 200, right? Remember the stock price. This is payoff once again. So covered call, you still have the stock, right? But you sold the call, so the call looks like here. And then, right? So when you sum it up, the covered call end up see, this is 200. So the covered call goes like this. Go up till 200. Then right? So what, in English, what happens is that when the stock price goes above 200, unfortunately you're not, and that's the key, right? You're not gonna participate. It's as if you lost the portfolio. You only get a constant value of 200. Right? And if you, and I know you're gonna find this strange. When the stock price goes below 200, you actually lose some pay. But remember, you did get the revenue, like the premium, right? So that's what I meant by you got your insurance money up front. Because as far as the value of the portfolio is concerned, it's going down, baby. It is going down. Like it's not protected. That's the point. Questions about it? So it looks like you're protected. Yes, you're protected in the sense that you get insurance money. But it does not necessarily make up for the loss here. Yeah, Peter.
Sorry, but it's not like going, so above 200 is flat there.
Yeah.
Okay.
Above two, that's the thing. That's the other thing. Is above 200, it's just 200.
Yeah. So
Yeah,
maybe
you-
whatever profit I had then actually stabilized at whatever.
Yeah, too much. Too much stabilization.
I mean, that's it. That's a ceiling.
Yes, compared to this.
Yeah.
Here, if it goes above 200, like 201, then you get a value of 201, etc., etc. Do we see the difference? Right. So talking Greeks is fine, but you also have to look at the bigger picture. Right? And the bigger picture is that if you use, and this is why protective put is known, that's the part that's known as portfolio insurance, because that's the more routine way of doing it, because you do not sell your upside potential and you do protect the downside, right? Which is the classic insurance idea. Oh, and by the way, I mean that in a literal sense, right? An insurance policy typically is a good option. It's a good option because when things go badly, that's when the insurance pays money, hopefully. When things go well, nothing happens. Well, you pay the premium and the insurance company is happy. So literally insurance policies typically are good options, right? And it's a classic way of protecting assets, including financial assets and otherwise. But like I said, because we talk about derivatives, we need to be aware of the covered call possibilities, so especially when the put option is too expensive, right? Then maybe that's a good thing. But you do see, even though when you make the decisions, the deltas are zeros and all that, but when you look at the bigger picture, you realize that you sold away your upside potential on your portfolio. And as far as loss of value, you do lose value. And the only thing you have in exchange is the premium you got from selling the call. Does that make sense? Any questions about it? And this is why I'm saying doing the Greeks, that's the way to do it, because that's a professional, literally all risk tests do Greeks and everything that we were talking about. But my point though is that even though I'm telling you that it's possible to do covered calls, it's not often that people choose to do covered calls because of what I've just told you, right? Even though the Greeks look right for a covered call, right? Okay, and so hopefully now you understand, every time you want to hedge one more Greek, you add one more equation, and therefore you have to add one more derivative, right? And that's all I'm saying there, right? So if you want to hedge delta, gamma, and vega, for example, then you need a third derivative to solve three equations: delta equation, gamma equation, vega equation, with three unknown, which is the number of each of the three derivatives. Okay? let's talk about portfolios, because so far, we focused on one stock, IBM. So, first, so you have a decision to make. And when I say decision, there's three alternatives, and then a fourth is a combination of some of the three alternatives. Let me explain what I mean by that. So you can look at your portfolio as they are right now, and then decide to do whatever we just done with IBM, but you do it for each one of the stocks in your portfolio. That's known as one of it mistakes are idiosyncratic risk hedging, right? So you've decided you're gonna go for each position's individual volatility. So you're gonna do, for example, delta hedging on each one of the stocks in your portfolio. Maybe delta and gamma. Why not? Right? So that's one possibility, right? However, you can also, and by the way I'm saying you can also, meaning you can do it simultaneously. You can also group stocks into sectors. So for example, instead of hedging IBM only, I'm gonna say that IBM is a tech company, and if I have, I don't know, Apple and some other stock, then I'm gonna have those stocks together. I'm gonna call it tech sector. That's the portfolio I'm gonna consider, and I'm gonna hedge that portfolio. And then I'm gonna look for other sectors in my portfolio, and I'm gonna hedge that sector, etc. You guys understand this, right? So I'm gonna have delta hedging on the tech sector. I'm gonna have delta hedging on the finance sector. I could have a delta hedging on consumer discretionary sector, etc. Do we understand this, right? So now I'm hedging. I'm protecting a group of stocks instead of just one stock. Then, and it, like I said, you can combine all of these, right? So whether you do what I just told you or not, you can also look at the whole portfolio as if it's just one stock. Right? So instead of calling it IBM, it's IBM, Apple, and blah, 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 whatever is in the portfolio. Right? And you want to minimize the variability of that. So you want to, for example, delta hedge that. So if you do that, you remember that delta is measured for a $1 change in a particular stock. So which stock are we going to choose in the portfolio to measure that again? That doesn't make any sense, right? No one stock should be more important than others when you measure risk, right? So what people do is they choose a particular reference, like an index, let's say the S&P 500, or it may be an ETF, right, on that index. And that's what you're going to be doing, right? Because this S&P 500 is on stock track, right? Well, I'm not going to do it, but you know the point is it's there, right? And by the way, so that third choice is a hedge against market risk. So if you have the Greeks of your individual stocks, right? So for example, maybe I want to make sure you understand. So the delta of IBM is 1. Because when IBM stock price goes up by 1, IBM stock price goes up by 1, right? The delta of AT&T is 1, but they don't measure the same thing. Delta of AT&T measures what happens to AT&T when AT&T goes up. Right? You guys see the point, right? So something has to give. So we have to use the same reference. What should go up, right? So that's where market risk comes into play, right? Maybe we choose the S&P 500 for the whole portfolio. And then, incidentally, what I've just said, you use that also if you're interested not in hedging market risk, but hedging sector risk, right? Then you choose an index on the finance sector or on the tech sector, things like that. And by the way, it does not have to be an index, it could be an ETF, right? Remember that. But if it's an ETF, in ETF you guys know it's a stock. So whatever I said, it applies, except that it's not an index, it's a stock, right? But here, basically, instead of delta, this is delta, right? We cannot combine these deltas in the same portfolios because they measure totally different things. However, we can measure it with respect to the S&P 500. So the delta is known as beta adjusted delta. And the formula is very simple. As long as you know the delta, the original delta, you multiply it by the beta. We all know beta from Kappa fame, right? And then times so this is a position in a particular stock, that could be a call option or a put option, times the price of the share divided by the value of the index, right? If you want, and then you do exactly what we did before. So first you compute the delta, it's a beta adjusted delta for each one of the stocks in your portfolio, right? And then you compute the beta adjusted delta of the whole portfolio, which is just the sum, right? Just the sum. Right? So if this is beta adjusted delta for IBM and you have 1,000 shares, you take this adjusted delta, multiply by 1,000, right? That's the position for IBM. And then you do the same for AT&T, and then multiply by the number of shares in AT&T, let's say 200. And whatever that number you have, you sum up to 2. That's your beta adjusted delta for your portfolio. Do we all understand this? Right? So this is the formula for that. And then if you want to hedge delta, you remember how we do it? We choose one derivative. We have to measure the delta of the derivative. You have to do this as well. You have to compute the beta adjusted delta of the derivative. It's exactly the same formula. Instead of S, which is the stock price, it's C if it's a call option. It's P if it's a put option. It's exactly the same formula. Basically everything I've told you, you do exactly the same thing, but instead of calling it Greek, you call it beta adjusted Greek. That's it. And this is the formula. If you know the original Greek, multiply it by the beta, and then the price ratio of the actual stock or the option divided by the index. Questions about that? Right? But it's exactly the same. Measure the delta of the components times the number of shares. Add them up, that's the delta of the portfolio. If you want delta hedging, choose one particular derivative. Measure its beta adjusted delta, and then go through the same delta equation that we went through, solve for the number of derivatives. Same story. What if you want to? Oh, something I wanted to make sure I understand. So when you use beta adjusted delta, you remember that, of course, beta is part of the story, right? Well, How do you compute the beta of a derivative, like beta of an option or futures or anything? How do you compute that? Well, actually, if you know the beta of the stock, then you know. If you multiply it by the derivative delta, and then the ratio of stock price divided by the value of the derivative, then you do get the beta of the derivative. So you don't have to, so that's the formula for the beta of derivatives. Why do you need the beta of derivatives? Because in this whole story, you always need beta adjusted Greeks. Right? And to finalize this, what if you wanted to hedge not just delta but gamma? So these are the formulas for beta adjusted gamma. You notice that it's the same formula as delta, but everything is squared. Why? Because gamma is a second order derivative. That's why. And vega is almost the same as delta in terms of adjustment. And that is it. So let me recap before you ask questions, right? Because you have a real portfolio to protect, you have to make first a choice, right? So do you want to hedge individual unique risks, individual volatilities for each stock position? And or, because they're not mutually exclusive, right? You could do all of it together. Do you want to minimize the volatility per sector instead of individual position? If it's per sector, you have to do this, right? Because each sector is defined by, let's say, one index or one ETF, right? So you have to find out the beta adjusted Greeks, and the beta is measured with respect to that particular index, right? And then the third possibility, and again, it's not mutually exclusive. You can do all of it together, or two of them together, right? Or just one. But the third possibility is you want to minimize market risk, right? So volatility with respect to the market, right? And in which case, you would use the S&P 500 index, which is what everyone uses, right? Because it's got a very rich set of options trading on it. So that's why it's a popular index for market risk. And same story, you still have to use these beta adjusted Greeks formula, but the principle is the same. When you want to hedge a Greek, you have to choose one kind of derivative, specific kind, and the equation for that Greek will help you solve for the number of units you need for that particular derivative. And then the other possibility is you add. You want to hedge not just that one Greek, but another Greek at the same time, right? So now you have two equations. So you have to have two unknowns, so you have to use two different kinds of derivatives, etc., etc. That's really what we've done, and you can do it with this as well, right? Instead of calling it delta, we call it beta adjusted delta. Instead of calling it gamma, we just call it beta adjusted gamma, etc., etc. Question? Yeah.
So if it's the stock, it's from the company formula.
Yeah.
And if it's like the option, like you say like call or put.
Right.
So we use the beta derivatives.
Yeah. You use this exactly. Right. So beta S is from the CAPM, and then you use that, the derivative. Absolutely. Other question? Futures are easy, I can tell you, and then I get back. For futures, so we're gonna talk about futures at some point. First of all, for those of you who have no idea what futures are, they're just contracts that allow you to buy, right? So you buy a particular stock at a given price, not now, but at a future date, which is the expiration. It's like a European option, except it's not an option. No matter what happens, you have to buy at that particular futures price. Do we all understand this? That's what a futures contract is. By the way, that's also a forward contract, same thing. The difference between the two, a forward is privately negotiated with a dealer. Futures, we can sit in front of our computer and buy and sell from a particular exchange, right? That's the difference, but it's the same thing. It's like a European option, European call option, except you don't have the option. You have to buy no matter what. You have to buy at that price, which is the futures price, right? And so, if you want to use that, the problem with futures is a little bit more restricted. You actually do not have like a lot of futures on individual stocks, right? What you have a lot of is futures on a lot of stock indices, right? So that might be helpful. So for those of you interested, so the delta of a futures contract is 1, and all of the other Greeks are 0. That's it. Very easy. All right. So obviously, if you start using something else, like options, then the other Greeks are not going to be 0, and futures are going to be useless to hedge those other Greeks, right? So that's the idea. Futures will be useful only for delta hedging. That's it. And then if you want to hedge something else, then it's not very useful. I mean, it's not very useful. It's useful because it takes care of the delta, but it's not going to take care of the others. Any other questions?
I just
Yeah.
have another question besides the theory.
Sure.
Like in real life, I can see that like hedging is almost, we follow the same structure and the same process where we follow this like equations.
Yeah.
Like data hedging.
Yeah.
So do you think like the company, they use AI to automate the hedge?
So, that's going to be more and more. So before they didn't do that, by the way, right? So you actually had a lot of people in a risk desk, right?
Yeah.
See, the problem with AI, at least the way it is now, right? It is hallucinating like crazy when it's something sophisticated like that, right? It says crazy things. And so companies don't trust it right now. They do automate some stuff, but not like the final result of the decision, but some parts of it,
Kind of like how to calculate data. And how
That's
to
it. That's exactly right.
suggest the position to
Yeah.
put in.
Yeah, so, for example, you can use AI to solve the simultaneous equations, right? Instead of using Excel and bothering with the matrix formula, you could just say, hey, solve this, and it will solve correctly. That's the good news, right? It has trouble doing 1 + 1, but it has no trouble solving simultaneous equations. But that's because a lot of people have solved simultaneous equations online, right? And very few people ask, what is 1 + 1? So of course, what is 1 + 1? It's got a hard time. The model has a hard time predicting what the next word is, because you guys did not ask on internet, what is 1 + 1? Right? So that's the idea. But yeah, so that will come some part of the time. That's true of all of finance. some tasks are being automated, but it's not the whole job of any person, right? Some of the specific tasks are being automated. And that's why it's very hard to measure the economic impact of AI in finance, because some companies have tried to let a lot of people go, and then they realize, oops, actually, no one is there to do their job, because AI is not doing the whole job. It's doing some specific tasks very well, and some tasks really very badly. Right? So that's the answer to your question, is that some tasks are operated like solving simultaneous equations, or find me the, it could solve, for example, the following problem. Find me the cheapest derivative for this particular stage, like that delta and find me the cheapest derivative. And then if you do delta and delta, find the cheapest candidate derivatives, right? That's the answer. So it could, because then it would, if you feed it the, for example, the pricers or anything, you tell it, use these pricers to price the object. It will do it, right? So it is capable of doing it. But, so these are like parts of the tasks, but it's not the whole thing. And ultimately, as we speak, no one in their right mind has ever let AI make the decisions. Like, yeah, that's just like crazy. That's like adding risk on top of risk. not very safe. But yeah.
Professor, considering the fact that index option, like as you mentioned, like the S&P, we know they typically follow, these are European, in terms of its computation. So now, when it comes to hedging, you said we're going to use those Greeks
Yeah.
to hedge a particular portfolio.
Yeah.
So how are we going to go about that?
So that's a great question. So the question essentially is, when you look at the Greeks, right, are we talking about European options or American options? Here's the good news. We're talking about both. You know why? Because remember how we actually do it, right?
Yes.
If it's a formula, we know if it's a formula for European option, like Black-Scholes, or if it's a formula for American options, like Bjorkson, for example, right? So we know when to use which, and each will give definitely a different value of the Greeks, for sure. And you can check it on the prices, because the prices you have to compute the Greeks. So that's number one, right? And then number two, if it's the simulation type, like binomial or geometric Brownian motion or anything like that, same story, right? We make a distinction between whether we're using the simulation for, let's say the binomial, right? You saw that there's a toggle, and you could toggle between American and European, right? And same story. Basically, the short answer to your question is the deltas would be different. But it's exactly still the same principle. We still use the same principle. Does that make sense? The Greeks will be different for sure. Not in signs, but in terms of magnitudes. Yeah?
So can you go back to the
Yeah.
previous slide?
This
The
one?
delta, the beta, just the delta.
This one?
This one, yes. You said like, on the top, if we have a code, we put it in the code value. on
Yeah.
the-
Yeah.
Instead of SI, right?
Yeah.
But how about the denominator?
No, because so the whole idea of beta adjustment is because we measure the change in the value of everything with respect to the change in the value of one particular reference, one particular index. right? Because, for example, in this example, we're interested in hedging against market risk, meaning if the S&P 500 goes down, we don't want to go down with the S&P 500, right? That's basically the story. So if our portfolio includes options, we have to multiply by the value of the option divided by the level of the S&P 500. Because it has to be with respect to the S&P 500.
So it's the same.
It is the same, exactly the same. Right. The only thing that changes is the price that you use and the beta, right? The beta should be the beta of the option. And that requires additional computation like that. Right? Make sense? Here's the good news. These are all just formulas. So you just type it once on Excel and you're done, right? Doesn't matter what values you input, etc. It's always going to be there. So, right. Other questions? All right, so look out for that assignment tomorrow. And then we're probably going to, so I quickly talk about futures in the remaining sessions, and we're probably going to, at least I'm going to try to help you with the last assignment. It's important that we experience the right thing, right? The correct things, right? All right. See you again next week.
Sure, so next week is our last lecture or?
No.
Two.
No, because we still.
2 more.
So technically, at UConn, the week of the exam is the first week of May. So we still have, that's it. Yeah. So that's why definitely I will be done with futures, and I probably will help you that. Two weeks is pretty long, to be honest with you. But yeah, that's right.
I think individual